Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. So an ugly, ugly day, especially when you talk about the NASDAQ, and I'll run through, even you look at the losses that the NASDAQ index suffered, doesn't, again, represent the damage that we've seen under the hood at various points over the last several months, several weeks in the market. Just overall, the indices don't give you as clear indication that things are really not healthy in this market right now at all. And even yesterday, I talked about how even though the indices and the NASDAQ was able to finish positive, there's just signs that the market is sick right now. There's not that underlying feeling that we had last year, for example. We're melting up. The resilience is there and pretty clear, and there's not the type of scary intraday volatility that we've seen in the last several weeks. Some people might attribute that to geopolitical worries and Russia and Ukraine and all that, but I think what you're just seeing is that bigger players in the market right now, the people who move markets, are deciding that growth stocks in particular are not something they're interested in owning up here. And you're seeing those people dump stock when they can, create these dead cat feeble type bounces, and those bounces are really just another opportunity for people to unload stock. And even after strong earnings reports, which I'll get into in a second, you're seeing those get sold off pretty aggressively, which is the exact opposite of what we've seen largely over the last couple of years. And Amazon is a stark example of that, which I'll get into in a second as well. But anyways, let's take a look at the indices. First, I'll take a look at the S&P, which you talk about not providing a clear indication of the health of a market. The S&P 500 is supposed to be the broadest, most representative index, but because of sector rotation into those safety sectors, into the value sectors, which is a theme that I talked about every time I've been on here with you guys and talked about in Scott's morning note, contributing to that with Scott, is just you're seeing rotation into those value sectors that's allowing the S&P to hold up. You're seeing sort of a broadening formation form here in the S&P as you made new highs, new lows, but this time we made a lower high, and obviously today big down bar. We only finished down around 0.8 in the S&P, but again, that does not reflect the type of damage, extreme damage that we saw, especially in certain tech stocks today. You look at the chart of the Qs, you can get a clearer picture of it. Usually on Scott Redler's morning note, we just include a chart of the S&P. We look at key levels because that's the index that he watches most closely. But this morning I decided to throw in a chart of what I was seeing in the NASDAQ and the Qs. Scott Redler's morning note is part of Scott Redler All Access, a subscription package that we sell. You can learn more about it on the website. But what I was showing, and this is something that Scott's talked about before also, is basically you had this downtrend that's been in place in the Qs, and you can draw it in a number of ways. But the Qs, even though it had bounced, it was really just coming back into a key trend line and a key resistance area. And the fact that it got rejected there yesterday after some really strong earnings and a strong gap up, and even went sharply negative or went barely negative yesterday after being sharply higher after the open, that was a sign that this trend line is going to serve as resistance, and we're going to get rejected there. And then we got the downside follow through today with a gap and go to the downside. So the NASDAQ finished down around 1.6%, I believe, so about double the losses of the S&P. And this is providing you a little bit better picture of the damage that we're seeing, but even so, a 1.6% loss is much less significant than some of the 10% losses, 5% losses, 7% losses that we saw in big stocks, in key stocks today. And it's just another sign that I think institutions are selling blocks of stock, and after big sell-offs, we get some of these dead cat type bounces. You get people thinking, maybe we could bounce, get back to highs again. You sort of spin people in circles, and just following traders on Twitter who fashion themselves as really successful traders. These people don't seem to have really a clue right now, and they're getting, like I said, spun in circles at every moment. Every time I feel like somebody starts to get really bullish, that's when we reverse, and you sort of have to take a contrarian mentality right now if you want to keep up with the market moves, or you just sit on your hands and wait for things to become a little bit clearer, which I think is what a lot of people are doing. But going into some of those huge moves down that we saw today, earnings season has been a telltale sign. It's sort of some of the reactions that we've seen to decent earnings reports have been sort of a canary in a coal mine for what we could see, I think, in the indices and for more stocks going forward. And a couple days ago, you look at something like Facebook, and Apple's a complete opposite end of the spectrum, which I'll talk about too, but something like Facebook reported a monster quarter. It had pulled off pretty sharply from highs, beat top and bottom line estimates. Mobile ad revenue continues to accelerate, but it opened up 5% on earnings and engulfed the entire previous day and finished with pretty decent losses. And then today a gap and go to the downside to be sharply below where it was going into earnings into a strong report after it's already pulled off pretty significantly. So expectations weren't really that high going into the report given the pull-in that we saw, and it still wasn't able to bounce from there. So that was one big telltale sign for you that people are looking to sell even decent reports. Look at Netflix. Netflix had an outstanding report, and obviously there's been a lot of talk about the competition coming from Amazon and potentially Apple and stuff like that, but huge quarter for Netflix. Instead of one of these monster gap and goes that we've seen at various times in Netflix, it was also pretty significantly off of its highs, but still that monster report was only able to trigger a gap that held for about a day and a half, 2 days. And you saw acceleration of the downside today in Netflix, and it looks like, to me, given how fast it filled that gap and given the potency of today's down move and the fact that it closed on its lows, looks to me like it's headed lower. And then if you want a more recent example today, Amazon. Amazon's report wasn't bad. It was basically an inline report. There were some numbers, if you dig deeper into the report, that weren't great. Their revenue growth isn't accelerating and holding up maybe the way people would want it to, but the revenue still grew by something like 23% from the year ago quarter. So not a bad report. Also pretty significantly off of its highs. Had a pretty big pullback here so far in 2014, but an inline report, even at depressed levels, wasn't enough to allow Amazon to bounce. Not only was it not enough to allow it to bounce, stock finished down 10% today. 10%, that is a huge move. That is not anything to sneeze at. Given the gains that we've seen in some of these stocks over the last several years, in the context of the chart, it doesn't look huge, but 10% down move in a stock, that is something that is definitely not a sign of health, and something that I think when you see potent moves like that, those potent moves are a harbinger of things to come and lead to more downside eventually. There could be some chop, there could be some bounces thrown in there, but I think that's why you grow your time frames a little bit, and just I think you turn around in 6-8 months or so. I think Amazon is going to be pretty well lower based on what we saw today. You see that huge gap and go to the downside, 10% loss. So just another example of people looking to sell strong earnings. And then Google. I mean, this is one of the bellwethers within tech, and also didn't report bad earnings at all, and just wasn't able to hold any of those gains and breaking key support levels now. Google finished down around 2%, so not the extreme weakness that you saw in something like Amazon, but you talk about breaking levels, you talk about bearish patterns, looks like a little bit of a macro head and shoulders type pattern, which you're also seeing in the Qs, which I Scott posted a chart of the Qs ETF on his Twitter accounts this afternoon, talking about the head and shoulders pattern there. You're seeing something very similar in Google, which is not a coincidence given that Google is a pretty significant component in the NASDAQ. And then I talked about Facebook, and then look elsewhere in social media. These growth stocks that fund managers look like they wanted to own at all costs. You see that huge move Twitter had after its IPO before it even reported any sort of earnings. And now look what's happening with Twitter. It had a little bit of a bounce, put in a little bit of a bull flag type pattern at lower levels. But that's why you use time frame analysis. And you love bull flags on stocks that are trending higher on basically all time frames, at least on your daily time frames. And Twitter, it did have a bounce off of lows, but it's still a laggard type pattern given the pullback that we've seen so far this year, starting in late December. And so you saw that bull flag fail, and then acceleration of the downside today. 7.2% loss around there for Twitter. So another really extreme move, and one that looks like it might want to break the $40 area. It has earnings coming up, so earnings will obviously play a huge role in whether or not it does break that $40 area. But people are calling it twit space these days, where they think it could go the way of MySpace and sort of become irrelevant in this battle for social media. I love using Twitter myself, but they need to prove that they can monetize their platform a la Facebook if they're going to turn things around. And they've only had one public earnings report so far, and they weren't able to prove that at all. So this one will be very important for Twitter, and could set the stage for either another big correction or maybe a move. I think it's going to be a big move in either direction. I don't know what options are pricing in right now, but definitely one to keep an eye on after earnings. LinkedIn, another one. Gap and go to the downside, really potent, coming into key support levels. Sort of poked its head below this key support level here around 158. And you talk about time frame analysis. this is one that looks bearish on a lot of time frames. You go back on an ultra long time frame, or one that goes back to its IPO, obviously had a huge rally from where it IPO'd from, but you look more recently on daily charts over the last 6 months or so, this is extremely bearish in a descending channel and accelerating lower out of that descending channel, which is very bearish. Again, this is a key level back from last June that's breaking, in addition to it being a recent pivot. So if it breaks that, you have a gap here that almost looks like it wants to be a magnet for LinkedIn down around 120. I would not be surprised at all to see LinkedIn down there. So social media getting hit along with a lot of others in tech. And then even the stocks I talked about in last night's recap that I like, that have been holding up well and showing relative strength within this growth sector, those got crushed today. Zillow, for example. Zillow is one, we talked about a bull flag type pattern that was forming well above all of its moving averages, 8 and 21 day, 200 day, looking great. But they came and whacked this thing in one fell swoop today with a huge wide range potent red bar. Zillow also finished down around 10% like Amazon, and not very encouraging at all. But this is one that if it did get a significant correction, and I talked to some traders about this, is during the weakness that we've seen in tech over the last several weeks to a couple months, I was wanting a correction in Zillow. One, because I love the product. I could spend all day on Zillow. I think it's an outstanding service that is disrupting an industry, real estate, that needed and was ripe for disruption in terms of bringing more transparency to the way the real estate market works and the way listings are posted and things like that. Financially, fundamentally, is it really performing all that great so far? No, not really. None of these huge growth names probably justify their valuations right now, but valuations don't matter until people decide that they do. And it seems like a lot of big hedge funds and stuff like that are starting to take note of some of these really lofty multiples of these tech stocks and deciding that they're best served to dump some of these and rotate into some more value type of sectors. And that's what we continue to see. You look at GTAT. This is some that people some people thought might get some sympathy strength on Apple's really strong earnings. And I'll talk about Apple after this, but GTAT makes sapphire displays, which could be used in the new iWatch whenever that maybe comes out. Could be used as future displays on iPhones. And Apple's invested hundreds of millions of dollars to help GTAT increase their production. But GTAT today finished down around 7%. So really extreme weakness there. Another name like Zillow that I've been talking to people about how I would love to see a big time correction in GTAT to buy it. I'm one that I would rather be ultra patient and miss out on an entry to get some size in a name like this than I would buy it expensive and run the risk of exposing myself to a big pullback. So I would love to get it down the $10 area. Is that realistic? Maybe, maybe not, given the relative strength that it's shown. But given how strongly it bounced off the 400 or like the 14 and change area, I guess, a couple weeks ago, if it gets back down there, I might look to dip my toe into a little bit more GTAT, and it's one that just continue to monitor it after today's potent down bar. But just an example of how even the strong ones got hit and punished today. And just one to look at, Yandex. There's not a lot of Russian stocks listed on U.S. exchanges, but given the geopolitical issues that we have right now in the Ukraine and Russia, Russia seems almost hell-bent on starting some sort of war. Putin just wants to flex his muscles and rile the West. People are punishing these Russian stocks and any stock with exposure really to Russia and Ukraine. And Yandex was down today something like 20% at one point. As you can see, big tail closed well off of its lows of the day, but still finished down around 10%. And that's even after it's pulled off pretty significantly so far this year from mid-40s, cut in half pretty much now. So a lot of punishment there. We'll have to see if that continues. And then going to Apple to wrap up tech. Something we also posted on Scott's Twitter this afternoon is that Apple is sort of becoming a hybrid right now and moving more towards value. I'm talking about a hybrid between a growth stock and a value stock, and moving more towards the value sector every day with the increased share buyback program, with the increased dividend. They're splitting their stock. That doesn't necessarily have play a role in value versus growth, but potentially could attract a new class of investors, as I talked about in yesterday's recap. I'm not a huge fan of the split unless it's for some reason like for inclusion in the Dow going forward, they needed to reduce the size of their stock because 70 and change, which is going to be around the split adjusted price. Now it's in the 80s split adjusted with that 1-to-7 split. That's around the average price of a Dow stock. So some people are saying that's a little bit too much of a coincidence that they would do an unusual split like 7-for-1 to put it at that price level. But anyways, this seems to me like an area that people are rotating into value stocks right now. Apple is becoming more of a value stock, and in general, it just trades on in its own little island right now. And even when the market was strong, Apple was sometimes weak, and vice versa. And sometimes you saw Apple rally on days when the market was weak. It's just sort of doing its own thing, and I think that might be a positive thing now. I think it might be a place that people look to park their money in, get a little bit of dividend yield, expose themselves maybe to some potential growth with an iPhone 6 phablet or new products with like an iWatch or a TV or any other wearable or something like that. But technically speaking, that would also mesh with what we're seeing right now. And I talked about how a lot of stocks that reported earnings have been selling off sharply following good reports. Apple came out with what was a really good report, multi-pronged good report with the split, with the dividend, with the buyback, and also just with their top and bottom line numbers. And this one's holding up really well. To see the NASDAQ today down 1.6%, while Apple, its largest component, was up around 0.6, 0.7%, that makes it even worse for the NASDAQ, that its biggest component could be strong and it could still finish with extreme relative weakness to the other indices. But take a look at Apple. Obviously, that 575 area, 52-week highs, is going to be the next big level there. It's not far from it after today's really nice bar where it went out on the highs. So I would definitely expect Apple to take out that level. Maybe if it just goes sideways for a while and digests this recent news and waits for the split to go into effect or something like that. But this is definitely an area that I would keep an eye on where money could get parked. And touching on, well, first I'll go into the solars. The solars right now, you talk about divergences. The solars, a case of the haves and the have-nots, is understating the amount of divergences that we're seeing here. And there's really a couple stocks to me that are separating themselves within the solars. The sector as a whole, I sort of like it. I think technology in the solar sector is improving. I think there's a demand for it. But like I said, some people are executing, some people are not. And SPWR today came out with really strong earnings, announced partnership with Google. I don't know a ton of details on that, but as you can see, all of that news was really well received. And to see it, gap ups are great, but you love to see strength during a session. You love to see commitment during a session to an upside move, and that's what we saw with SPWR today. Finished up with sharp gains. I'm not sure the exact percentage, but it looks like it might want to get back to these recent highs. And generally speaking, given some of the corrections that we've seen in other areas in tech, this one's actually been holding up pretty well. It did go down below its 8 and 21-day moving average. Went down below this upper level range briefly, but looks to me, based on this igniting bar today, that this could be back at highs. And the other one, obviously, that's been holding up well that I've talked about many times is FSLR. It did finish down today. Obviously, SPWR showed a lot of relative strength even to FSLR, but even though it did get an overthrow below this upper level range, I still think it's holding up well considering the turmoil that we've seen elsewhere in tech, and it's one that I would definitely feel most comfortable buying if you're looking for some sort of growth, whereas other growth names are really getting hit hard. So those are the two names that I really like, but you look at some of the other names in the group, look at a YGE. This is a Chinese solar name, sort of a smaller one. Big gap down, finished down 17% or 13% or so, I think, today. And then you look at another name that's not a Chinese name. Obviously, Solar City is a Musk name. That one's really weak. TSL is another China one. Weakness today on the YGE. Big pullback since the beginning of March. So obviously a case of the haves and the have-nots. Some people are executing, some people are not. FSLR and SPWR, to me, look like some of the best growth setups that are out there. But there's a lot more good-looking setups in value names, and that's what I've continued to harp on, is that traders are frustrated because they really know mostly one thing, and that's trading momentum names, trading high beta names, the volatile names that you usually find in the NASDAQ, you usually find in tech. But those are stocks that are proving very difficult to trade right now and just also really volatile and unhealthy action. But in these value sectors that long-term cautious investors generally park their money in, they're getting rewarded right now. And, it is what it is. I wouldn't say it's a good thing or a bad thing. It's just the people who are identifying the environment that we're in and adapting their approach to that are the ones that they might not be making a killing with these stocks that move like snails, but at the same time, they're not getting hurt the way A lot of traders are out there talking about how they are now, at least the honest traders. There's some traders on Twitter who you think they never make a losing trade. There's some traders out there that are pretty honest about the struggles they've been going through, and that's what we try to be, is very honest about things, and it's been a difficult environment. But you look at the TLTs, that's what's been driving this, and the clearest example of this is that you see bonds remain strong. A little bit of a topping type tail today, but TLT still did finish positive for the session. Maybe could digest after a really strong move so far this year. But that strength in bonds, look at utilities. Close on the highs, another breakout for the XLU. XLP, not blockbuster strength. You're not going to get 10% moves in consumer staples and utilities, but really consistently strong strength there. And you talk about consumer staple type stocks, IMO, Altria, cigarette stock. Traders are pretty damn frustrated right now. A lot of them are going out front smoking cigarettes during the trading day. Hell, maybe that's why Altria is higher. And then Reynolds, same thing. Those are two of the strongest stocks in the market today. And Reynolds sort of holding up, forming an upper level base here. So you're seeing sort of those SIN stocks perform well, which are consumer stocks, which sometimes you see. But just another example of the type of rotation that we're seeing. And then even the banks. I've been focusing mainly on tech, but even the banks not looking healthy. And you look at the XLF, you could call these somewhat of bear flags, these really steep channels that we created in a lot of stocks, a lot of sectors during this 2-week bounce. And then the XLF is breaking down below it. Bank of America was one of the weakest today. Didn't bounce as strongly as the XLF, and then now is breaking below this flag type pattern. And it's another case of where you see relative strength sort of reset every earnings season within the banks, and Bank of America has become one of the weaker ones. If you want to own a bank, Wells Fargo, by far the best one, and more of a value bank. And so you're seeing rotation within value stocks within sectors, and that's what you're seeing with Apple within tech. It's becoming a value tech name. You're seeing the Microsofts and the Intels and the Ciscos hold up well in tech, along with something like Apple, which is becoming a value name. Same thing in the banks, Wells Fargo. And another one that looks really concerning to me, Germany has a lot of sort of contagion with Russia and Ukraine, a lot of exposure to those countries, given that it's an Eastern European or closer to Eastern Europe. Look at Deutsche Bank. It's one that we've highlighted as a potential short before, and it sort of shook you out of the trade a couple times. But again, triple bottoms don't really happen that often, and it looks like Deutsche Bank might want to break lower as this Ukraine-Russia situation looks like it might want to escalate. Wouldn't be surprised to see Deutsche Bank down here around 40 in the next month or so. Yeah, and then the last point I wanted to make is about gold. Gold is something that I've never been a big bull on gold. I've never been a big bull on Bitcoin or any of that stuff. But gold is something that's interesting to me right now from a technical perspective based on the last couple of days, but also just sort of an anecdotal perspective, is that you haven't seen real concrete fear come into the market except for a few pretty mild pull-ins recently in the market. But even though the S&P is still not that far off of its highs, I think you could see a return of some of that fear. When you see 10% down moves in Amazons, and you see that type of move in Zillow, a stock that's been holding up well, and you see the banks sort of coming apart a little bit, that can sort of trigger a little bit of fear. And I wouldn't be surprised. Obviously, the VIX is something to watch, the fear index, but I also think gold is another place that people could look to park some money. And I talk about igniting bars a lot of times as when you see a really potent igniting engulfing bar, sometimes that can usurp some trends that are in place when you talk about the precedence and the significance of a move. And I think that's what we saw yesterday a little bit in the GLD. If you look back on this chart, yeah, GLD bounced at the beginning of the year, and it's bounced at various times. Even a few weeks ago, it put in a little bounce before trading back to those pivot lows. But you haven't seen the type of igniting bar. You saw some gaps and stuff, but you didn't see the type of igniting bar that we saw in GLD yesterday. And then to see it commit to that igniting bar with a gap up today that held, it looks to me like gold could improve, and definitely this is an area where I think you could get involved here. Again, this is not something that I've been very bullish on ever in the past, but with things sort of coming apart a little bit of fear coming into the equation, I think it's definitely something to keep an eye on. When you're making somewhat of a counter trend long-term trade idea like this, you always have to have risk management in place on a laggard idea. So it's not something that I would buy and put in the drawer or anything like that. But you give yourself a drawdown on gold or gold miners. Take a look at something like GDXJ, the junior gold miners. Gold miners were strong into the close. These are names that I think that if you buy right here versus these lows, I don't know if those lows are going to get taken out anytime soon, given some of the fear that we're seeing. So just another idea that I don't really talk about gold a lot, but something that looks a little bit more interesting anecdotally and also technically right now for me. Just to wrap things up, I've come on here not to be a Monday morning quarterback, but even yesterday talking about the action that we saw, despite the fact that the indices finished higher yesterday, the type of sell-off that we saw off the open yesterday where things went negative after some pretty big gap ups, that's not healthy action. That's not a sign of a healthy market. The rotation has been sort of hiding a lot of the damage that we've seen, especially in the S&P. And people are talking about how there could be a potential huge correction coming in the market. It's not coming, it's here. There is a correction happening, and there was sort of, I don't want to call it a dead cat bounce over the last 2 weeks in the NASDAQ, but a really feeble type bounce. We were able to put in 6 up days, but it wasn't something that was very tradable and didn't have a whole lot of power. And then it sort of stares up, elevator down, the type of market that we've gotten used to since around the financial crisis, is that gains that were accrued over the course of several months can be taken away in the span of a few days when fear starts to hit. I never believe that these geopolitical crises like what's going on in Russia and Ukraine, those are generally transitory type situations, but the situation doesn't seem like it's going to go away. It seems like something significant. And given the strength or the weakness that we've seen in areas that have a lot of exposure to Russia, I think it's a sign that this could be a bigger problem for the market, or it could be just an excuse for the market to get that correction that people have been waiting for quite a long time. So I definitely feel more bearish than I have at any point over the last few years about the market. And I think you could look to buy extreme weakness in strong stocks, but I also think in weak stocks, if you get bounces like the ones that we got over the last couple weeks, I think those are going to continue to be shortable, because even though we have seen big down moves in names like Amazon or other names that have gotten hit pretty hard recently, given the context of where they've come from in the last several years, they still could have more downside in store, in my opinion. Anyways, this has been John Darsie here for your daily recap. Everyone have a good weekend. Scott will be back on Monday. We look forward to navigating the market during an interesting time for sure.